The Post-Stock Act Paradox: Why Congressional Trading Transparency is Creating a $4 billion Retail Copycat. That single number resets the tech playbook. The key question is not what happened, but what changes next for operators and users. We will map trigger, incentive shift, and downstream impact before the close. The goal was simple: force politicians to disclose their stock trades within 45 days so the public could see if they were trading on insider information. Sunlight as disinfectant, right? Well, that transparency just created a $4.2 billion fintech ecosystem, and retail investors are walking straight into the trap. Within hours of a congressional disclosure hitting the House Ethics website, apps like Quiver Quantitative, Capital Trades, Unusual Whales, and Autopilot have already parsed the data, analyzed it, and pushed notifications to millions of subscribers. One congressman files a trade, and 2.3 million retail investors get the alert within 48 hours. The pitch is intoxicating: copy what senators buy, get the edge, get rich. The reality is far darker. Let's start with the performance numbers everyone sees. These platforms are plastered with stats like Senator X's portfolio up 47% versus the S&P's 23%. Sounds incredible. But Columbia Business School just released a working paper analyzing 14,000 congressional trades from 2020 to 2025, and the truth is brutal. First problem: survivorship bias. The apps highlight Nancy Pelosi's wins and quietly ignore the dozens of members whose portfolios massively underperform index funds. You're only seeing the highlight reel. Second problem is timing. By the time a retail investor sees the alert, reads it, decides to buy, and actually executes the trade, roughly 12 days pass. In that window, 73% of the measurable outperformance has already evaporated. You're buying yesterday's edge at tomorrow's prices. But here's where it gets genuinely concerning. When 300,000 retail accounts simultaneously pile into a mid-cap biotech stock because 3 senators bought it, the sheer volume creates artificial momentum that has nothing to do with the company's fundamentals. That's not price discovery, that's crowded trade dysfunction. And sophisticated market makers have figured this out completely. Citadel Securities updated their algorithms in May 2026 specifically to detect and fade these congressional copycat patterns. They're now systematically buying shares just before retail orders hit, then selling into the retail-driven spike. The research suggests sophisticated traders are extracting $180 to $240 million annually from app users, not through insider trading, which is illegal, but through pure algorithmic front-running of a predictable retail flow. Here's the truly clever angle that nobody's talking about yet. If you know a congressional trade will trigger retail buying pressure 10 to 15 days later, and you can model which sectors and companies are likely to appear in upcoming committee briefings, you can actually front-run the disclosure itself. At least 2 quantitative hedge funds are apparently running exactly this strategy. They're monitoring congressional calendars, predicting which stocks will be disclosed next, and building options positions before the actual trades hit the public databases. Renaissance Technologies even filed a comment with the SEC about systematic price patterns preceding disclosure windows. They weren't admitting guilt, they were basically saying the game is already being gamed at a level retail hasn't reached yet. So what happens next? The regulatory response is coming, but it's moving slowly. The SEC is talking about shortening disclosure windows from 45 days to 7 days, which would reduce the free option period for front-running. They're also considering requiring exact transaction timestamps instead of just date ranges, which forces fintech platforms to compete on speed rather than data mining. But here's the thing: speed is what Autopilot and others already have. The real fix is structural. The most interesting development is Vanguard's reported plan to launch a governance index fund that would automatically track congressional holdings with a 30-day smoothing mechanism and charge just 10 basis points. If a major incumbent offers this product legitimately, it could actually drain the copycat app ecosystem entirely, because retail investors get the exposure they want without the predatory single-stock concentration and algorithmic disadvantage. The core insight here is this: transparency doesn't eliminate information asymmetry when markets move fast. It just relocates it to whoever can process data the quickest and most strategically. We've created a system where retail investors feel like they're getting insider edge but are actually providing exit liquidity for algorithms operating 3 steps ahead. The fix isn't less transparency, it's transparency that's designed smarter, with mechanisms that account for how information actually propagates through modern markets. Congressional trading apps proved there's real demand for governance-linked investing. Now the question is whether regulators will channel that demand toward products that genuinely inform, or watch as fintech extracts billions from investors who think they're copying Congress when they're actually copying each other into losses. This is worth paying attention to. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next.